Hi everyone, welcome to another edition of the Market Update with Demo Gonzalez here of Heartwood Financial Services. I hope everybody had a good Thanksgiving. Chris and I and the boys, we had a nice one. We headed up to Tennessee. It was pretty cold up there, but it was a nice change of pace. Speaking of change of pace, we made a little format change. Um, some people told me, hey, these videos are great, but they're a little long. So we made it so that the first part of the video is going to be more of a summary. And if you keep watching, you'll get into the extended version that gets into more details. And so there'll be a natural spot where you'll know you can turn it off. But if you want to hang in and watch more of the details, welcome to do so. I've added a little bit more detail than I have in the past as well, so I hope you enjoy. Thanks. Let's get started. Now here are the asset class returns. As you can see in the red, we have the large cap stocks. They continue to do very well. They've been leading the pack for the year and also leading for the month, up 3.63%. But the small caps had a nice showing. They're actually been doing very well when you look at the last few weeks, especially. Seems like maybe things are turning around a little bit and small caps tend to lead. So we'll talk a little bit more about that later. On the real estate's been, looks like taking a little breather. It's done really well for the year. Rates have started to creep up a little bit, and that tends to hurt real estate. And so you can see that reflected in the month, but still a great performance year to date. On the international front, developed and emerging, both have done well. Not as well as domestic. Both also had a decent month. Emerging markets pretty flat. A lot of the news from China has been on and off, and China has a lot to do with the emerging market performance. And on fixed income, the green, as you can see, the month number is pretty much flat, and this is with interest rates going up a little bit. So that's nice to see. They're pretty well held up. High yield was one of the better parts of the bond market. It was up a little bit, and it's been doing really well year to date relative to the bond market. And probably the biggest laggard was the commodities in general. Mostly oil has been going down a little bit, but still up for the year, and overall a pretty good performance for the market. You guys, when you get your statements, you'll open them up and you'll be pretty happy again. Okay, so here's what's been going on in November. I'm going to start with probably the most important development, which is what's going on with trade, especially with China. Still no deal, okay, but it does look like we're getting closer. Seems like every other day there's some bad news that comes out, the market goes down. There's some good news that comes out, the market goes up. But it seems like the trade talks are moving forward, and it does seem like both Trump and President Xi, they both want a deal, and I think they both probably need a deal. So that's one of the biggest reasons why we've seen the market perform as well as it has, is the promise of that deal going through. And so the question is the economy rebounding? Well, I would say we're not quite rebounding. It's not getting worse. It's been slowing down. But the reason the market's up is mostly because of the trade developments, not so much because the data is great. Now, there was some good news today about the jobs numbers. But remember, the jobs numbers are still kind of backwards looking. Forward-looking numbers are still conflicting. Some aren't so good. Some are a little bit better. So I would say the jury's still out on calling this a rebound. The Fed has officially paused after 3 rate cuts, as you can see here. And so it's a little change of pace from the last Fed meeting when they were, seems like they were a lot more accommodative. I think they're probably done. At least they hope they're done. So we'll see. They say they're data dependent. which is code for we hope we don't have to do anything again. But we'll have to see. So that has been another aspect of why the market's done well. These rate cuts have helped the housing market and many other parts of the market. A couple other last points is low rates change behavior. With interest rates this low, it is pushing people into riskier types of investments, which is why you've been seeing the stock market do well and the prices start getting a little expensive. Also why high yield bonds and real estate and things like that, things that pay interest or some sort of dividend, be very popular. It's that search for yield. It continues. Small caps, are they set to rally? I believe that things are starting to turn around for small caps, especially if we see some economic change that we are getting into a little bit of a rebound. Anytime the manufacturing numbers get low and then they bounce, small caps lead. So there is a strong possibility of that. And then overall, we're in a low growth world. When you look at the global economies, the GDP numbers continue to be estimated a little lower and a little lower. And in that kind of world, we want to look at things that are growing. And so one of the areas is emerging market. And I'm going to get a little bit more into several of these topics if you want to hang in here and listen to the more detailed version of the update. But you can kind of see where things are going here. And I'll give you a quick outlook and summary here next. Okay, so here's what I see going forward. First of all, optimism prevails. We still have a lot of optimism around the stock market, maybe a rebound in the economy and the trade talks. I think a lot of that has been priced in, so it makes me a little nervous, but also hopeful that things will actually happen as we hope. But as you see the market go up, it makes that being priced in something to be concerned about. So that's something I'm watching. Number two, we have global growth still soft, but showing some signs of life. We have seen some numbers that have been coming out a little bit better out of Germany and China and some of those areas, so there could be some rebounding. And I think a lot of that does have to do with the trade talks starting to go better. That's loosening up China and really the rest of the world. But we have this tariff that could potentially be coming into effect on December 15th, and it's looming because Trump has talked that he's going to put it on. In fact, he's even saying that he wouldn't mind waiting until after the election, although I have a hard time believing that. I think that's probably more negotiation tactics. I don't think he wants that to happen. That would probably not be good for the 2020 elections. But December 15th is coming up, and if we raise tariffs, I think the market could stumble here a little bit. If they delay it and push it back, I think the market would like that. That might already be priced in. So it'll be interesting to see. So there is some potential tension there. And then, of course, we have the impeachment inquiries. They continue to build. Most people, most investors, institutional investors and whatnot, aren't looking at this as a serious issue yet. But it's not going away. It's definitely a thorn on President Trump's side. And it's giving China a little bit of fodder to maybe push back a little bit. And so as that continues, that could make the trade negotiations go a little tougher. Again, something a little bit to be worried about. So that's why, as you see in number 5, we continue to stay in a neutral stance. We've been taking advantage of the market and how it's been performing. But we still are hedging, thinking that maybe things could slip back if things don't go as well as we'd hoped. And so again, if you want to get a little bit more detail about some of the topics, just stay tuned and we will be discussing that a little bit more. I'll give you a quick educational piece and the end, and if you stay on, we'll get into more of the details. So it's December, so the end of the year is almost here. So before the end of the year, there's just a few things that you should check twice, as my little title here goes. And so I made a list of some essential things I think you should look at before the end of the year. Please give me a call if you have any questions on these items. I'd be happy to get into more detail. Of course, in this video, I'll just be brief. But first of all, maxing out your 401k and HSA plans. Since you can't do those past the end of the year, definitely take a look at those. Look at your pay stubs. Look at the contributions. Charitable giving. There's now a couple different ways you can give to charities. You can give charities directly from your checking account or your investment accounts. But you can also give the charity from your IRA if you're over 70 and a half and doing the required minimum distributions. So that's something that I would be happy to talk to you about as well. Tax loss harvesting. That is something that should be going on throughout the year, but it's a good time to look at it at the end of the year in December to see if you have any losses that you could sell, maybe offset some gains, lower your taxes. This is something that I do on a regular basis for my clients that have taxable accounts, but also a good reminder for the end of the year. Roth conversions, the deadline is December 31st. That's where you take your IRA and transform it into a Roth IRA. It's actually a pretty good long-term thing to do, but there's some tax implications, so it's not always a straightforward type of transaction. So let me know if you want to talk more about that. And of course, RMDs, that's required minimum distributions. You need to get those done before the end of the year. If you're a Heartwood client, I help take care of those for you. But if you have IRAs outside, you need to make sure you're calculating and making the withdrawals for those. There's a pretty steep penalty, 50% if you don't. And then the last thing is, at the end of the year, mutual funds pay capital gain distributions, short and long term. They usually give you a heads up either on the website or some email or some sort of a feed where they tell you what those distributions are going to be. Where this is most important is if you're going to be buying more of a mutual fund, you probably don't want to buy it right before it pays the dividend because it is of no economic gain to you, just a taxable gain. And so if you can avoid that, that would be a smart thing to do. And this is obviously something that I look for when I help with your taxable accounts. Okay, so any questions, let me know. But that's a good list to remember for end of the year. Merry Christmas
and a Happy New Year.
Okay, welcome to the expanded version of the Heartwood update. The first point that I talked about in the summary was about the economy and was it potentially rebounding. And the leading indicators report that a lot of you have probably seen. Again, the top shows that we are in a growth scenario. The right side shows it's expanding, where on the left it shows that growth is declining. And so when we get into this rectangle, that's when we're at the point where the stock market has historically started to price in a recession. And so right now we're in this red, which is the average of all these different data points like existing home sales, manufacturing, non-manufacturing, consumer sentiment, so on and so forth. And so this is pretty much exactly where we were in November. It really hasn't changed very much. And that's what I meant by in the introductory piece where there's some conflicting information. It's not clear really that the economy has been improving that much, especially to justify the market. So obviously the market is trading more on the trade news at the moment. Okay, here's the latest math behind the market chart. Of course, we're looking at the S&P 500. And as a quick review, what we do is we look at where the price of the stock market is, which currently is at 31.45, but it changed a little bit in the last hour or so. And then we look at the earnings of the next 12 months and what that growth is, which is 4.4. The earnings number, okay, and then we look at what the normal multiple of the stock market. It's usually around 16.2. And so when you do the math and you look at, okay, take the earnings times the multiple, and where should the stock market be? I have recently added a multiplier of 1.1 because interest rates are so low, PEs do tend to go a little higher. So even accounting for that, I show here that we should be somewhere around 30.50. And so 31.45 is showing that the stock market's a little expensive. Now why is that? Obviously, most of what's happening here is the trade talks have been going pretty well. And so folks are anticipating that if there is a trade deal, that we might get earnings to go higher. Now recently they've been kind of flat and in fact going down a little bit at 171.04. But if things start getting better with the economy, there's a trade deal, China starts really churning growth out, maybe that earnings growth for the next year is going to be better than 171.4. And so we'll get a higher stock price. So that's possible. It's being somewhat priced in already, which is never good. You want to buy before it's priced in. So that's another reason why I'm not really aggressive at the moment, because of the price of the market is a little on the high side. Okay, this is a chart that shows interest rates and inflation. And in the summary, I talked about how interest rates being so low, it's changing behavior. And so this chart here shows in the blue line, that's nominal 10-year treasury yields. You can see how they've been going lower and lower and lower. Still positive. We're at around 1.8% right now. The gray shows the real yields. This basically takes that blue line and subtracts inflation. And so what you can see is after inflation, the 10-year treasury yield is actually slightly negative right now. Inflation is about 2.32, I'm sorry. And so it's a little bit more than the nominal yield, so that's why you get a negative real yield. And so in that kind of environment, you can see why folks are looking for yield, looking to get some sort of positive yield, going into real estate, going into preferreds, high yield, going into other alternative investments, including stocks. And so you could see why the market has been going up, especially lately as the Fed has been lowering the yields. Now what you can't see on this chart, because it's a pretty long-term chart, is that there's been a slight little blip up in rates here lately, and that's because the trade talks appear to be making some some good strides, and so interest rates have been starting to go up a little bit, and maybe that will continue if the economy will rebound along with the market. We shall see. Now in the summary, you heard me talking about how maybe small caps might be ready for resurgence. And this was a study that I found really interesting. It was from the Royce Funds family. And they manage a lot of small cap funds, so of course they do a lot of studies on this. And what they found out is when the ISM index, the ISM manufacturing index, goes below 49.3, which we're currently at 49.1 on that ISM number. And once it's at that figure, that's how much the small cap index, which we're looking at the Russell 2000, has done over the next 12 months. See the Russell 2000. 21.4%, pretty impressive. Now, on top of that, if the ISM is below 49.3 and the Fed is also been lowering rates year over year, that even makes the returns in the following 12-month period even stronger. Now, the average is the gray number up top here at 12.8. And we've been performing a little bit below that here over the last few years with small cap stocks, especially relative to large cap stocks. So what we're seeing here is a potential for the small caps to do better. So you'll see me adding a little bit more of the small cap exposure, especially as I see that confirmation of the ISM starting to at least not get worse and maybe rebound a little bit. And then lastly, we have the slide about the emerging economies. And so you heard me talk about this low growth world and looking for the areas that have growth in this environment. And I mentioned the idea of emerging market stocks. Now here's part of my thinking with that. There's so much data I could show you on this, it would be hours. But this was one that I thought did a good job of summarizing. You can see in the purple line here, this is the growth of emerging market economies in their GDP, and the gray is developed market economies. And so you can see that there's quite a differential. All right, now emerging market economies do tend to have a little bit more risk, so we demand a little bit more growth in order to invest in those. But what you're seeing is a differential that's pretty large. And so it's encouraging for people that like to buy low and get good growth. And another aspect is the demographics of emerging markets. You could see here in these different emerging market economies, India, China, Brazil, Mexico, you can see the growth of the middle class and the projections over the next 10, 12 years is pretty great. So again, lots of opportunities there. We want to make sure to have exposure there. My emerging market exposures may be a little bit higher than the consensus for a lot of your typical portfolios, but it's because of the demographics and the growth and the environment that we're in right now that I'm using that exposure. So thanks a lot.